Welcome, all of you, to the Startup Impact Summit, the venture stage. In this section, we are going to have a panel discussion of On the Way to Exit. We are incredibly happy to have Danielle and Karen as our speakers, and the panel will be moderated by Benedicte today. Without further ado, please join me in welcoming the panelists.
Hello, everyone. Hi, Karen. Hi, Danielle. I would like you to start with quickly introducing yourselves so that the audience can know what your focus area are.
So my name is Karen Contet. I'm the co-founder of WHub and AngelHub. So we are the biggest startup community, also organizing Startup Impact Summit. So thank you all for being there today.
Hey, good morning. My name is Grossman. I'm one of the co-founders and managing partners of Kharis Capital. Kharis Capital is a private equity firm focused on growth and technology innovation investments in consumer markets.
Okay, and as to myself, I'm currently actually for one day in between jobs. I was in SC Ventures yesterday and I will be in the BAS tomorrow. So, so it's an odd day for me, July 1. So let's start. So Danielle, in terms of the startups you invest in, question for you is whether you actually think about exit from day one.
It's a very interesting question. I think we're living in quite interesting moments in the private equity world. I think the market is evolving and we're moving away from, the traditional 5 years horizon that is typically valid for funds, where in reality, after 3 years, you have to start prepping for your exit. And after 5 years, you have this natural rotation, and then the fund have to exit. I think in that mode, call it private equity 1.0, yes, you had to talk about exit day one, because actually quite soon you had to think about the exit. And the timing of your exit actually dictates a lot on your strategy. And I think in private equity 2.0, in which we live, I think it's also a new way of doing investment that Kharis embraces. We take longer term views, and that basically allows company to rather live their full development strategy and time the exit based on their needs rather than the private equity fund needs. So in that world, you have, I think, a bit more flexibility to think and prep for your exit. Now, this being said, preparing for an exit is extremely time consuming. It's worse for all the entrepreneurs in the room. They know that raising capital, first time capital, second time capital for a company is extremely time consuming. Preparing for an exit is actually worse than that. So it can put your company to a stop. So you really need to prep your exit, and that basically means get your strategy right, get your narrative right, and take the time to do that. So the sooner you start, of course, the better prepared you are. And I think that's an area where investors can play a quite active role.
Okay, so quick follow-up question on that. So it's many say that, as you say, these companies, they stay private longer. So these days you see sometimes Series D and beyond. So do you as an investor have a view as to, by which series, let's say, a company should really be ready for exit?
Yeah, I mean, I can go on. I think it's a good question. I think, again, it ties a lot to your strategy. What's your strategy in the market? What's your own strategy? Do you have a long-term goal? Do you want to be, do you want to be acquired by Amazon, or do you want to find, a vertical or a business model where you will not compete with Amazon? Do you need to run really, really fast and acquire the market and then be up for sale? And that might be in 2, 3, 4 years from now. And that can be Series C, Series D, because at the end of that, you may run out of money. Or to the contrary, you take very long-term view on your business, and then you're going to raise Series C, D, E. And then you might choose to go IPO rather than traditional trade sale or sale to another private equity fund, because you think you will be able to continue to drive your strategy even as you have been providing liquidity to some early stage investors. So it's really, I think, very much in function of your own strategy. And again, I think that is what should be at the heart of every entrepreneur today. Your own strategy should dictate your partner selection and should dictate the exit of your timing. I think if you manage to do that, which is not easy, I think you will be able to really grow the company in the way you have anticipated it to be growing.
So let's say for your portfolio companies, and towards the first question, so from the beginning, do you form like some impression of whether the company is targeting, let's say, M&A or IPO, or is that too early?
Yeah, I think that if I can jump in, so for us, we invest into mainly like early stage companies that are more into Series A, type of rounds. Of course, it's not very clear which type of exit strategy it's going to happen, whether it's going to be acquisition or IPO. I think for us, it's more in order to plan the exit strategy to be really a partner in terms of all the legal documents that are going to be, taken. Because actually, usually, most of the time, entrepreneurs don't realize that even like their first Series A, is very important in order to plan the exit strategy. Who is going to be in charge of the control of the company? Who will have, the decision power in order to decide whether to sell or not? And also, as an investor, will you have actually sufficient rights in order to be able to jump into an acquisition? Or if you're too much of a minority shareholder, you won't have any say and any right to benefit from it. So in terms of planning, it's not necessarily for early stage company, which type of exit strategy, do you want to go for the company, but more like, okay, will I be able actually to benefit from it? And I think that's where it should align. And then after, it's really about the investor. Okay, do you want to invest for like 2 years, for 5 years, for 7 years? And then you need to look into the company's like growth strategy in order to align with the investment that you're going to do.
Okay. So Karen, a follow-up question for you. Sorry, Daniel, go ahead.
I always have a lot of sympathy for the younger entrepreneurs who spend a tremendous amount of time raising their capital. And of course, often there are the questions, so when and how are you going to sell your company to who? What's the exit strategy? And so, of course, you have politely to put this slide together with a few logos of companies to whom you're going to sell it, and it's kind of tick the box. In reality, I think that often entrepreneurs, when they ask that question, investors, when they ask that question for young companies, it's really a way also to think through the business model, to understand where's the gap in the market. What do what problem do you solve? And is the market big enough? It's often also a way to think about that rather than really having a very clear thought from day one when you set up your company as to, okay, this one is going to be sold to that person, And actually, if you know that, that's great, because that will allow you to actually build your milestones in order to get there.
Yeah, it's really interesting. So I think you both highlighted the need for quite some discipline, right? Both in the legal documentation as well as in going through the thinking process, even if it's dynamic and agile as you proceed in your business model. And obviously, having been in a startup myself, that is exactly how I felt about it as well. So, Karen, quick follow-up question. So if you think about exit from your experience so far, what have you thought is the most important, really? The team, the market, the business model, product, technology? Maybe the answer is every one of these, but would like your thoughts.
Definitely every one of this. And I think what is really important first and foremost into a company is really like the people, the product, and then the profits, and that will really align and come together. And also in terms of, what is really important is, okay, what is the most valuable asset of your company? Because, sometimes it can be your customer database, it can be your product, it can be your technology. So what are you selling? And sometimes it's not necessarily in terms of the profit of the numbers as well. So we have a lot of examples, for example, like WhatsApp. So I think that's really one thing that you really need to consider into your company and focus in terms of your growth development first, and then the exit strategy will come.
Okay. So, Danielle, question for you. What are the traps you think that should be avoided for an exit?
There's many, because there's traps, I guess, a long way. The road of your development that actually leads towards the exit, that ties a lot into your strategy, and there are certain pitfalls probably at the time of the exit. I think to kind of concur with what Karen just said, I think the number one pitfall, I guess, is not to have an exit narrative. You know, people need stories. You need a story. You need a real story about your exit. You need to be able to tell, and at the time of exit, it's probably evidence-based. You need to be able to tell, what am I selling? What is the asset I'm selling? And to explain that. It's not like the first day that you just tell the story about the future. You've had a couple of years of existence. So what are you effectively selling? And you have to tell to the next acquirer, whether it's a trade buyer, private equity fund, you have to tell them, how will they continue to create value in the future with that asset? And then last point, what is the strategic value for them? And then, of course, there's a variety of answers. But I think not having the right narrative that you need to start building up really quite soon, and that ties into all the development steps that you've done, is one element. And start building that quite soon. Of course, you have the flexibility over time to adjust your narrative, but you need a really clear story. I think that's along the way of your Second, I think that you need, at the time of the exit, to be extremely disciplined and realistic. As I said earlier, it's an extremely time-consuming effort. It's an effort that is led by the entire organization. It may put your company actually to a stop for a few months, which can be quite detrimental because there's a lot of external factors in an exit. COVID, market shutting down for IPO, initial lots of interest and then no interest anymore. And so there's common pitfalls where often maybe as an entrepreneur, you'll be tempted to have those one-on-one discussions because, you know, someone comes and you have a good relationship and you start having that conversation. In fact, that takes a lot of time. And then you move to another one and another one. And at the end, without realizing it, you spend a lot of your focus on that. So I think you need to be very disciplined. You have to pick your timing and you have to define, I start now and I stop then. I think you also need to be quite careful about expectations. Of course, you know, we all dream about this huge, amazing, multi-billion exit. You have to be realistic. And for that, you also have to be quite mindful of the banker or the advisor you're going to select to accompany you. They have added value. They know how to run a process, but at the same time, you know, they make a commission out of how much, you know, you make. So you need to be realistic in expectations because often, you know, setting the wrong expectations may again lead for months of discussions and lead to nowhere. And maybe the third, you know, kind of pitfall that I can think of, that I think that's quite useful for, again, younger startups, you know, maybe part of this audience is along the way that you're building your cap table, you know, should you bring in like strategic partners, strategic investors on board, yes or no? It's not an easy question. You know, do you want Google as your partner in your startups? Yes or no? Do you want, you know, in the beverage world, do you want Coca-Cola as your partner? Yes or no? And there can be some constraints when you do that and some advantages, of course, of bringing someone like that on board. So I think, as Karen mentioned earlier, the investment documents, the governance, the type of rights you concede when you do that. I think not mixing potential commercial arrangement with pure financial investments criteria are very important element, you know, that will impact, you know, your exit. So you have to think about the exit almost at every stage of your company just to make sure that you are not losing flexibility.
And if I may jump in, because as Daniel said, it's actually, you know, quite complicated. And I think, you know, as an entrepreneur, but also an early stage investor, you need to be very humble on where you have your capacities. And, you know, sometimes as an early stage investor or as an entrepreneur, you have no experience into getting into an exit. So it's really important to find the right partner. And I think that's really what we're trying to do, you know, at AngelHub. Is to have many partners along the way in order to be there, you know, for the startup, to help them to grow at all these different stages, to have all the right partners, whether it's, you know, corporate, whether it's VC, whether it's PE, whether it's legal, to really help the process along the way. Because as an entrepreneur, you shouldn't be the only one, you know, bearing actually all the weight into planning all these things where you have no expertise. And what you should do is more like, you know, grow the business and have a clear strategy for the business, and then help for these kind of things that are not really in terms of your competence when you start.
Yeah, so one thing I wanted to ask about is we've talked, for example, about purely the legal agreements, let's say that you sign with your potential shareholders, whether strategic or not. But what we haven't spent a lot of time on is thinking about other legal aspects. For example, data privacy, which is relevant to every single technology startup nearly. And very closely linked to it, governance matters, such as, for example, the security of your platform, because if it gets hacked, that's when you have your privacy issues. So how much focus do you see at the different stages, I would say, of investment, but leading up to exit, on the governance of the company? And that's the whole governance, whether it's the compliance governance, the legal governance, the security governance, and of course also the financial governance, i.e. The soundness of the books and the records. So what is your feel on that? Because obviously in the Series A phase or the seed phase, in the seed phase, I would say, it's often a little bit or very light on this front, but where does it get heavier on all of this? And it ties up to your point, Danielle, that if you get a investor of the type you described, they may much earlier expect that governance, which could in fact slow you down as a startup as well, because you have to put more emphasis and more capital from the start on governance of the company.
So happy to jump in first, Karen. But yes, I think governance is actually very important throughout the life of your company. I think there's probably two aspects to it. As soon as you start bringing a professional investor on board, I think you can trust them with all the complexities of all those rules that are linked to governance. And if you build a trusted relationship, which should be, of course, the purpose and the objective when you bring someone on board, I think as an entrepreneur, you don't have that experience, and you can rely on your investor to have all those rules regarding privacy, data protection, and all the other kind of standard governance principles in place. And then you probably learn a lot because, quite frankly, you have to read this 100-page, document and you read like legal terms you never heard of, etc., etc. It's quite important actually for you to understand them. But I think it's important. And quite frankly, from that point of view, there's no silly question. I mean, it's complicated. And, if you work hand in hand when you invest on that, I mean, you need to make sure you understand everything. But I think you can trust them on that. The other part is really the part where, as an entrepreneur, through the governance, you probably don't hand over control of your destiny to one or more investors. And that ties more into, where do you draw the line between where investors, have a say and where you have a say, and the line can vary a lot, Do you give them rights as to kind of define the timing of an exit and anti-dilution protection and things, that are impacting the capital structure is quite standard. But you go as far as giving them rights in the actual operations of your company. Do they have certain veto rights on budgets, on spendings, on partnerships? And if you go that, you choose a very different path. And there, I think you have to be quite careful. So I think it encompasses a wide variety of questions. But the line for you as an entrepreneur is really where do I agree between losing control on the day-to-day business versus having an investor accompany me throughout the life of my company in order to make it successful for both of us.
And maybe one quick follow-up question from your investor standpoint. So when you see a startup, right, do you prefer a startup that has one of these investors? Or do you prefer a startup that doesn't have one of these? So in essence, I guess what I'm asking is, as a general matter, are you considering the amount of say you have and how that gets diluted by these other parties? And is that a positive or a negative, or it could be either, depending on the circumstances?
So look, I mean, quite rapidly we invest in consumer and consumer technology. I think it's two different worlds. When you do pure consumer investments, which typically are longer term, larger amounts for Kharis Capital, we like to take control, or we like to be the sole investor. because indeed we think we can bring all that to the table. We're quite an active investor from that point of view. When you invest in technology, and Karen will be able to confirm that or say more, when you invest in technology, you often work in partnerships. So I think there you need to be mindful about the fact that you need to share those rights amongst with other investors, and it has to be a good balance of interests.
Yeah, I think it's always a matter of balance, and that's why it's very complicated, because actually there is no one contract that fits all, and I think that's why we are having actually this discussion. You don't want to lose the control of your company. As for ourselves, we are usually minority shareholders, so what we want is really to have all the information about the company in due time, to be able also to help the company. So it's a balance about the amount of work that you're going to give the entrepreneurs in terms of reporting and of discussion that you want to have with them in order to be keeping updates of the company and to make sure that you can plan accordingly for like the next fundraising or the next stage of development. So it's true that it's complicating to draw this type of line, but for us it's really about making sure that we are here to know about the company. When you're not on a day-to-day operation of the company, there is also a lot of help that you can bring, because you have an external set of eyes into the business. So it's more about getting all this information rights and a little bit of like control and reporting that is really key. And the more institutional you will go, usually the more stake of the company these new investors will take on, and the more control they will have on the company as well.
Mm-hmm. So maybe you both can comment in more detail on exactly the type of investor support, or support in your case, Karen, as a platform that you give to these startups.
So for us, we really want to give opportunity for high net worth individual to invest into tech companies, and to be part actually of this adventure and to generate revenue as well. For the type of investors that we are dealing with that are investing through AngelHub, they don't want to have control of the company. That's exactly not what they are looking for. They want to be able to invest a small ticket size from like 10,000 US, 50,000 US to diversify that portfolio, but they don't want to be bothered by any, day-to-day or any type of paperwork as well. So we are handling everything, and we really make sure that we pass on all the information of the company to the investors, and that's really what they are looking for. So that's one of the type of investors that we are dealing with directly. And so it's really different from having like individuals investing a small ticket size and the rest of more institutional investors. Then we partners a lot with VC in order to share deal flow, but also in order to share expertise. I think when you invest into a company, the first question that you also ask yourself as an investor, or that we ask ourselves as investor, is really, okay, what value can we bring to this company? Where can we actually help them to grow? And that's why we are really focusing on companies that are operating or scaling in Asia, because that's where our expertise lies. And then after, with our network of like corporates, VC, PE, marketing, and media, we can really help the company to its next levels. And it's really different. And then with VC, it's more like sharing deal flow and expertise. And then after, with later stage type of institutional investors, what they are looking for is more like the deal flow, to be able to invest into this company and to have the background of this company as well. And there is really a trust relationship.
Okay. Yeah,
that one, Benedicte,
go ahead, Brian.
I think that as investors, we also have a license to network and to talk. I think that at the end, the one thing we can do, and we do all the time, and I spoke about the importance of narrative and storytelling before, I think we are constantly promoting the companies in which we invest. I think we fall in love with them. I think, we like the founders, we like the products, we're probably the biggest sponsors, ambassadors, and we talk about them. And through that, we actually network. And I think that as an investor, we have actually the right to network in a deeper way than entrepreneurs. We can talk to potential acquirers, we can talk to other potential investors, we can even talk to competition, because we look at the landscape. And so through that, we can bring a different perspective about the market, about the opportunities than entrepreneurs. I believe it's this magic match, you know. Entrepreneurs will always know their business, you know, deeply inside out. We'll never really be able to help them on the day-to-day basis because they know better. But we have this kind of more vertical way to look at, you know, the landscape, especially at Kharis. You know, we help a lot of companies develop internationally or go through their digital transformation journey. So through that, we have a lot of networks, contacts, different points of view. And when you bring those two together, the knowledge of the entrepreneur and let's say the more high level view of the investor, I mean, there's this magic match that happens, you know, once in a while, and that's great.
Yeah.
Yeah. So it's great to hear your passion. I totally agree with you that let's say from my perspective, I don't have a family office capital like yours, but individual capital I think a lot of us do have, and it does allow you to be part of that journey of that entrepreneur. While, you know, in my case, I continue working and earning income, you know, it is great to be associated by, you know, investment with people who are doing something really different and often the things that you can't do yourself. So that's, I think, the most exciting bit about the startup environment and in fact the startup scene that we've seen develop in the last maybe 5 to 10 years, and to which Karen AngelHub, of course, has been an extremely important platform for Hong Kong to bring this possibility, as you say, for smaller investors to be part of these startup journeys. So maybe one more question for Karen. What would you consider a successful exit and let's say the best timing for it?
Yeah, I think really the successful exit, usually for an investor, it depends on the multiple that you want to get back out of it. Usually, as an investor, you know, you want to get your money out of it, and for the individual that we represent through AngelHub, that's usually, you know, what they want and what is really important. Now, as an entrepreneur, I guess it's really something that is different. It's either, you know, making a lot of money, which is one thing, or really bringing your company to a next level, even though if it can be acquired by a bigger group, but that you can even, you know, put into place the vision that you have initially.
Mm. So Danielle, maybe a last question for you, and then I'll have a wrap-up question for both of you. So Danielle, do you view the exit as the end goal?
It's a great question. I mean, you touched the reason, I guess, why I'm in private equity or investing, because, of course, financially, yes. I think, you know, if it's a private equity-driven investor, short-term, mid-term, long-term, at the end, it's about exiting the business. But of course, there's also, I would say, the philosophical element, you know, both for entrepreneurs and as an investor. I can tell you, you know, we manage long-term investments. We have a lot of family capital backing companies. We have the time to be impatient. I love to say we can be impatient for a longer period of time, but that's dangerous because you can always find a reason not to exit, not to sell, you know. So you have to ask yourself the right question. I guess the question I always ask myself is, will the next owner basically do a better job than what I can do? You know, is the company, from my point of view as an investor, am I at the end of what I can contribute to a company? If the answer is yes, basically we have to sell. I give you a very easy example. I used to work for a very large established family office, and we used to sell, we sold vitamin water to Coke, you know, in 2007. You know, when you're investing in the beverage world, I've done many investments in that area. You know, when you sell to Coke or to Pepsi, you know, obviously they have a massive distribution network. It's something you can never achieve yourself. So at some point, a company is mature to enter into that network. As an investor, you've done your job. But I can tell you, you know, people say, don't fall in love with your investments. I mean, you heard me before. I absolutely disagree. I mean, fall in love with your investments, you know, fight alongside the entrepreneurs to achieve that. But it's really difficult, you know, and you have to be, again, very disciplined. It's frustrating sometimes for an investor, and you hear that a lot from I would say, private equity firms that are really constrained. They have to sell because, their documents tell them they have to sell. I mean, Kharis, we're not bound by those constraints, but, it's very frustrating. You hear them a lot of time telling, I wish I could hold on another 2, 3, 4 years on that investment rather than selling. How am I gone now? It's been successful. Now I need to find a new company and start the whole story again. So, there is some love element, I guess, in investing.
Good. So the closing question for both of you is, I think we've all been quite isolated these last few months, right? Because let's say I've been sitting on one chair actually successfully for 6 months in my bedroom, meaning hanging out with COVID, so to say. I know, Danielle, you're boarding a plane in the next hour, which is quite amazing. Enjoy the journey after a few months of being out of flying. But so my question is, as we all sat stuck in our own homes for quite a while, I'm sure we all have had time for reflection, right? And for thinking about including some of the things you've said. So what would you consider, let's say, your enlightenment or your moment of enlightenment or your eureka moment as linked to startups, our investing, our exits, that has crossed your mind in this period where we had more time to reflect?
I think really the one thing is that, the worst scenario can always happen. And I think that's one really key moment that you have during COVID, is that you don't want to plan for, the worst, but actually the worst can happen. So you need to be prepared, you need to be backed. And I think, that's really key. I think, I'm always quite positive. So actually in every crisis, I believe there are a lot of opportunities. And I think in terms of investment, we also saw a lot of different type of companies, and then definitely one sector that is really booming is the gaming industry. It's actually every day of the week became a weekend for gaming, and that's a huge opportunity of investment. And I think you really need, to be able to adapt to your environment, to find, the next sector, what is going to be the next big thing, and how the society is going to evolve. And I think, this COVID thing, despite all the bad things that happened and all the companies that shut down, we need to take the positive aspect of it, saying that, after the COVID, definitely there will be less investment opportunities. So definitely at some point, VC will need to invest their money, right? I mean, they are on a schedule. So, in a few months, we'll see a lot of money available for the companies that manage to survive. So right now it's hard, but you need to think about the long term. And then I think it's really about these sectors that will be booming even more than before.
Maybe I didn't think it during my home time, but I'm thinking about it now as you ask the question. I can think of two elements. One may sound a bit cliche, but think again, the strength of the team is amazing. I mean, we own a very large quick service restaurant platform in Europe. We have about 1,000 restaurants, $1 billion system-wide sales, 6,500 people working in that market, with us. We had to shut down overnight 1,000 restaurants. We had, to tell to our employees, to stay home and not to work, and this is something that you don't prepare for. And I have to say, when you see the cohesion of your team, your leadership team, being able to manage that with all the constraints of being locked down, you realize again from the inside the difference that it makes between a team that fights even in difficult times versus a team for which maybe it's just a job. Okay, so that's one, and it's really quite obvious in those difficult times. And the other one, probably I absolutely join Karen. Again at Kharis we've been, and before that we've been investing in technology companies for a while. And again, I think COVID has brought, has broken this another kind of glass ceiling. Now digital transformation is happening. No one doubts about it. You make certain choices at your company about new products, new innovation, use of tools that probably still had a lot of internal resistance 6, 9, 12 months ago. And today is, yes, you must do. So I think actually, if there is a benefit of this COVID situation, is that we've probably have a step up in people accepting change and basically investing in change. And I think that's great for all the technology companies, that are probably present, at this conference.
Okay. So just to wrap up this panel, I think we've heard a lot of interesting things. So I just want to summarize them. So Danielle, thank you very much for your point on the magic match and on falling in love. I think it's very, very important. And I think, to be frank, in terms of COVID, it's more important than ever to support the startups, but to support also SMEs. I go regularly now, spend money in places that have been around for a long time, and they don't know why I'm back, but I'm back there to support them. So that's what we all have to do. We heard as well that you help your companies on their international journey. I think this is very, very, very important. For any company who has an international ambition, you need these investors that help you along. Karen, you focused from the beginning in terms of the need for the legal side, the governance side to be in order. I think is critically important. Otherwise, you end up later with not the right control, as we heard. We also discussed, importantly, Danielle, that from the entrepreneur's point of view, when you think about exit, you need to know how that asset can really be accretive to the buyer. It's not just about it's accretive to you, it's accretive to your life, you're having a good time. It needs to be ultimately, if you want to exit, it needs to be sellable, and it needs to be something that other people need and can use better than you. And then you also mentioned that it is important to you as an investor. The decision on the exit point is also linked with whether the next owner can do a better job than you. And I think that's right. There is a time for everybody in life, right? There's a time for you to be somewhere. There's a time for you to be somewhere else. There's a time for you to be invested in one company and a time to move that money to another company. So anyway, very exciting. Thank you very much for all being here. And just for the record, we had actually three French speakers here, 2 Belgians and 1 French, which is a very rare occasion, 2 in Hong Kong and 1 in Belgium. And thanks, Danielle, for getting up at 5 a.m. to do this. And we wish you your good first flight in a while. Thank you.
Thank you very much.